Okay, Professor Jim Schultz here from my Finance 512 class. It is Friday, October 9th, and I am in the Thinkorswim software, and I wanted to go ahead and do a video on a few of the things that we covered in class just this last Monday. I know that some of the things I'm going to cover in this video are indeed included in some of the other videos that are available to you guys, but I thought it would be really useful if I went ahead and just dedicated an entire video to delta, finding implied volatility, and showing you how you can find the probabilities that are on the normal distribution curve, showing you where you can find those in the Thinkorswim software because they are already done for you, which is really nice for your statistical analysis. And as you can see, I am gonna do this video in full incognito mode because I don't want you guys knowing what's going on with my account. But as you can see, I'm a lot more active, and yeah, things are going pretty well. So let's go ahead and get started. So what I want to go ahead and do is let's go to the trade page and let's just pull up any stock. I don't really have an agenda necessarily. So let's pull up let's pull up Amazon. I'd pull up GoPro, but I'm pretty sure it went to zero today, so I'm not GoPro. I think it went bankrupt today. So maybe something else. Let's take a look at Amazon. So November, I'm already populated in the November options. So here's one thing that I didn't mention in class, but is important for those of you guys that kind of want to take your options trading to the next level. One of the things that I learned directly from the guys over at Tasty Trade, so I've got to give them all the credit for this, is the optimal time frame to trade, the optimal time frame to open up new positions is approximately 45 days to expiration. So when you look at your option chain, next to the expiration date, you see in parentheses how many days until expiration, or how many days until the last trading day. And they've done a tremendous amount of research over at Tasty Trade to determine what is the optimal amount of days to trade within. What is the optimal time window to execute your trades in? And they keep coming back to this 45-day number. And it doesn't have to be perfect. And so 42 is pretty good. And so most of my own positions right now that you kind of saw on the monitor page, if we went back and looked at those, almost all of them are now in November. I still have a couple of lingering October positions that I put on just a couple of days ago. I wanted to have some shorter time frame stuff, but I went ahead and most of my things right now are in November. And so I did some October stuff for some other reasons, but again, I'm primarily focused on November right now. So again, I want to focus on the task at hand, and we have three things that we want to cover. The first of which is finding your implied volatility number. Okay, so here's the first thing. I'm going to minimize this. And if you go down, I'm going to minimize that too, because this is what you might see, right? First of all, when you first click on a ticker in the trade page, you might see this. It might just look like that, right? Well, all you have to do, these are just kind of your minimize, maximize buttons. You just want to maximize the option chain. And then if you want to go down to today's option statistics, which is what I talked about in class, that's where you're going to find your implied volatility number for whatever stock you're looking at. So Amazon, implied volatility, boom, 52.69. So the implied volatility is 52.69%. So what that means is if you were trading the November options with 42 days to expiration, you could go ahead and plug that into the equation that I taught you guys, along with the implied volatility number, along with the current stock price of 538.75 or 539, and you could calculate your expected move across that time frame, which is really powerful stuff, right? I mean, that's, this quantitative aspect of finance, nobody is doing this, and this is what actually works. When you combine this with the fact that volatility overstates expected moves time and time again, you have some really powerful, repeatable, mechanical stuff on your hands. So here's your implied volatility, and it can be found this way for any stock. So we can pull up any stock, and it would be exactly the same. All right, so I want to minimize today's options statistics. So now I want to pull up the November options again. All right, so the first thing you want to notice is in the center, again, right? These are all your calls and puts. So right in the very center are all your strikes, or all your expirations, and then all your strikes. So the first thing I want to point out is right here, and by the way, your layout might look different than mine. You might still be running the old version. Thinkorswim updated their software about a week ago. And so they did a total kind of rebranding, kind of revamping. And so that's why yours might still be running the old system on the paper money accounts. I'm not sure. But mine, since I'm a real money customer and a paper money customer, I got the full throttle kind of revamp or recharge of the software. And so if yours looks a little bit different, don't get too discouraged. Everything is still pretty much found in the same place. It just might look a little bit different. So the first thing I want to point out is with these strike selections, you can choose how many strikes you want to look at, right? So if like I have it set to 60, not for any particular reason, I just happen to be doing some things where I wanted to look at some more strikes. Most of the time, I mean, about 20 strikes is usually good. And that will really kind of tidy up your screen and kind of narrow down what you're looking at, which can be extremely useful. But for the purposes of what I want to show you guys, let's go ahead and do 60. Okay, the next thing is in this layout column. So next to the expiration, the strikes, the bid and the ask for each strike, and so we already know what a bid and an ask is, so I don't need to talk about that. You can then choose what layout you want, which basically means the three columns that go after the middle columns that we talked about, what are you going to see in those columns? Well, you can choose a lot of different things. You could choose, theoretical price, you could choose volume and open interest, you could choose intrinsic and extrinsic value. And so this is actually an interesting one because a lot of these you guys probably don't understand, which of course we didn't talk about these in class, so I wouldn't necessarily expect you to understand them at this point. But if you want to take what we learned in class as a foundation and run with it and figure all this stuff out, then man, you are going to set yourself up for a lifetime of investing success. I promise you that. Trust me, that would be one of the best things you could ever do for yourself from a successful investor standpoint. But all that being said, if we clicked on the intrinsic and extrinsic value, let's click on that for just a minute. So the position column, I'm actually not quite sure what Thinkorswim is trying to show us with that. But intrinsic and extrinsic value, this we already know. Because we know what an intrinsic value of an option is, right? We already know that. All right, what is extrinsic value? That is the exact same as the time value in an option. So let me go ahead, and this is a very useful tangent. So let me go ahead and just narrow this down to 10 strikes. All right, so the price of Amazon right now is $5.37, give or take, and it's moving around quite a bit. Amazon is a very volatile stock. So if it's $5.37, let's just look at this. Let's look at this $5.35. Oh, I don't want to do that. Let's look at this $5.35 call. I just want to highlight it. So this $5.35 call is approximately $2 in the money, right? Because it's $5.37. In fact, it's exactly $1.99, $1.91. Well, look, what's really cool. The intrinsic value is changing as the price changes. And remember, the intrinsic value measures how much the option is in the money. So when you look at the option premium, and you can just take the mid price between the bid and the ask if you want to look at just one number. So it's about $34.70, $34.75, $34.65, somewhere in that range. So basically, that's where all this time value is coming from. It's coming from the difference between the mid price of the bid and the ask minus the intrinsic value in the option is going to give you your time value in the option. And so this is all the stuff we've already learned. But I just wanted to point out to you guys that another term for time value that's also very commonly used in the options trading world is extrinsic value. All right, but that's not what I want to focus on. I want to pull up the layout that I had up at the beginning, which is implied volatility, probability of out of the money, and delta. All right, so I'm going to click that, and I'm going to go back to 60 because this is going to make a couple of points that I want to make. All right, so here's the first thing I want to point out. And I don't want to spend a lot of time on this because this rabbit hole gets pretty deep and it would kind of get us off track. But the first thing I want to mention is you may be wondering, well, hey, wait a second, Jim, I'm a little bit confused. You just showed me where to find the implied volatility number under today's option statistics, but now I see that every strike has a different implied volatility. Well, that is exactly correct. And that's because every strike does indeed have a different implied volatility. And so the implied volatility number that you see under the today's option statistics is in essence an averaging of various strikes. And I don't want to talk about how that number is determined right now because that's way beyond the scope of what I want to do. But I just wanted to point out to you guys that when you go a little bit further, like a couple levels beyond where we went, you will indeed notice and understand and become aware of the fact that different strikes do indeed have different implied volatilities. So I just wanted to point that out to you guys in case some of you guys did notice that. Alright, but what I want to focus on is first let's focus on the delta. So remember what I said to you guys. I said the at the money option has a delta of approximately 50, right? Approximately. So the at the money option right now, we're at 537 and a quarter. So there's no clean strike. So it's essentially going to be the midpoint between 535 and 540. Well, look over at the deltas. Remember I said that they're always represented as decimals, but this would actually be referred to as a 54 delta or a 55 delta. So the 535 has a 55 delta. The 540 has a 52 delta. So we're right in between those. So we're at about 53 and a half, 54. So right around 50, right? It's not going to be exact, and that's because of the various different implied volatilities and all that kind of stuff. The Thinkorswim didn't make a mistake, and the options world doesn't make mistakes. It's all perfectly priced, and the reason why this isn't exactly equal to 50 like the 545 is has to do with things like volatility skew and all these different things that we didn't have time to talk about. But I just want to make you guys aware that the at-the-money options are approximately 50. Now what happens? As you get more in the money, which on the call side would be moving up, right? Because the strikes go down as you move up. Well, as you move up and the strikes go down, your call options become more and more in the money. And so you might be wondering, well, why would I ever want to buy the 435 call in Amazon for $108, right? Now again, most of that is going to be intrinsic value if you go ahead and pull up the extrinsic value page. But why might you want to do that? Well, you might want an option that essentially moves dollar for dollar with the stock. And this is going to move, you're going to get a 90-cent move in the option for every $1 move in the stock. That's almost dollar for dollar. Whereas if you do an at-the-money option, it's only going to be about 50 cents to the dollar. And if you do an out-of-the-money call option, you can see they're decreasing, just like we talked about in class. Now, if I flip it over to the put side, you're going to see essentially the same thing. Look at the 540. Again, this is approximately the at-the-money option, 535, 540, right? The deltas are approximately minus 50, right? Again, it's not exact because of the vol skew, but it's approximately minus 50. So remember, calls have positive deltas and puts have negative deltas. And so this essentially means that for every $1 increase in Amazon, this 540 put should go down by about 50 cents. And then what do you see? As you go down on the screen and these strikes go higher, these puts are now in the money and they have a lot of intrinsic value, which again, you could see if you changed your layout. And that is why you see your deltas getting, I guess for all intents and purposes, lower, as I wanted to say higher, but higher because they have a closer to dollar for dollar move, but lower in a mathematical sense because they're approaching -1. And then of course, as you move up on the screen and the strikes go lower, you're now out of the money for your put options, and so these deltas are going to be below 50 and getting progressively lower as you get lower on your strikes. And so that's kind of how you understand delta within the Thinkorswim layout framework. And then the next thing I wanted to point out was, you probably already noticed this as we were talking through some of the other things we went through today, but the probability of being out of the money. Well, here's what's really cool. If you were to calculate your expected move based on the implied volatility, and you were to calculate your expected move and plot it on the normal distribution curve, here's what you would find. Your 440 strike, your 440 price, is going to line up with approximately your 85, or actually let's do 444. Let's do 445. Your 445 strike, your 445 price well, it doesn't matter whether it's a put or a call, but your 445 strike or price is going to line up with an 84% out of the money. So this is going to be right at your 1 standard deviation mark. Do you remember how I told you guys how 84% and 16% is the 1 standard deviation markers, or are the 1 standard deviation markers on the normal distribution curve? Well, this is great because Thinkorswim already does it for you. They already calculate it for you. Now, if you go to calculate it yourself, you're never going to be exactly at this number. And that's for a couple of reasons. Number one, the price is constantly changing. So in the time you can do the calculation, even if it's in Excel, the price will have changed. And number two, remember, the implied volatilities are different for every strike. And so if you're feeding into the calculation the average implied volatility, you're always going to be off by a little bit. And there are actually a couple other reasons why you might be off by a couple of cents, or, a 0.5% or whatever. And that's because of how the Black-Scholes model, some of the other inputs in the Black-Scholes model that are way beyond anything we need to really be aware of at this point on the learning curve. And so I wouldn't be too concerned about that. But you will always be very, very close. And so that's the beauty of the mathematical or quantitative nature of trading. So again, if you wanted to do, remember I taught you guys how to do a short strangle, right? So let's say you're looking at Amazon at 539 and you're like, hey, I don't know which way Amazon is going. I have no assumption, or I have no hypothesis in the stock, but you know what I want to do? I want to sell some options because I want to make some money. So what you could do is you could sell a 1 standard deviation strangle in Amazon. So what do you need to do? You need to sell a put below the current price. So you want to sell an out of the money put. You want to sell that put at about the 84% marker. So you'd be looking at selling the 445 put. And then let's go down to the call side. You want to sell about the 84% out of the money call too, which corresponds to the 16% marker on the normal distribution. And so you'd be looking at approximately the 615 call. So really quickly, I know I did this in other videos, but just to kind of wrap this thing up, let's say you actually wanted to do that. Here's what you could do that's really cool in Thinkorswim. So I've got the 445 put, right? I want to sell it, so I'm going to click on the bid. So boom, I click on the bid, right? I'm going to sell a 1 lot of the 445 put. But I want to add on to that 615 call. So here's what I'm going to do. I'm going to scroll down to the 615 call. And what you do is you hold down control before you select sell. And then boom, it populates both orders for you. And Thinkorswim understands that you do indeed want to do a strangle. And so you're looking at about a 1420 credit for that strangle. So if you want to do a limit order, or if you want to just get this thing filled at a market order, whatever. I would strongly recommend, for your first couple of options trades, maybe do market orders just to kind of understand how things work. But once you do that and you become comfortable with the software, I would strongly encourage you guys to only use marketable limit orders in the options world, simply because the spreads in the options world can get wide, especially with stocks like Amazon, stocks like Priceline, these really high-powered stocks. The spreads can get pretty wide. Like if you just look at any spread, just pick any option. That's a quarter wide spread, right? And remember, if you're doing multiple legs, you've got a quarter on one side, you've got a quarter on the other side. And so a quarter is actually pretty good for Amazon. Like really quick, I'm going to delete this. Let's pull up like Priceline. We'll see some craziness. Priceline. It's like a stock, yeah, $1,300. I don't trade Priceline that often. But, I mean, look at the at-the-money option for Priceline, the 1310. Look at that spread. That's $1. That's what is that? $2 wide spread. I mean that's intense, man. So you probably want to only use marketable limit orders, and I would target the midpoint, the mid price on most of the orders that you do. So that was delta, implied volatilities, and probabilities of being out of the money. All the things that we talked about in class last time. So I really hope this was useful for you guys, and I will see you guys next time.